I think there's a big flight to quality that is imminent, not just on the institutional side, but on the retail side. Because look, whenever your investing strategy is based on momentum or things like meme stocks, it's because there's a vacuum. There's a desperate lack of an understanding of fundamentals. Because let's face it, nobody in their right mind would invest in AMC or GameStop because of fundamentals. And so when we finally do get a return to fundamentals, I think it's going to be strong and severe. And you're going to see a lot of these stocks that have been unloved and underappreciated for a while get a lot of capital.
So, David, I know you also pick stocks. Two of your picks are Disney and Walmart. Let's drill in on Walmart just for a second. It really seems like the idea that we're going to buy things from mega retailers is already priced into this stock. The stock far underperforming the market, only up 4% year to date. Amazon telling us in their earnings that, hey, people are just buying less stuff. What fundamentals are you seeing that is going to drive this stock higher, knowing that what we already know is that people want to get out of their house? They don't want to buy things. They still want to buy experiences. And even with the Delta variant, they want to travel more.
Yeah, well, the good thing about Walmart is you're not talking about like fancy, marginal sort of things you don't need. It's about the staples, and it's about getting them at a great price, and it's about scale and merchandising. Walmart remains the best and most successful retailer in the world by a long shot. They're growing their online business. And look, the valuation of the stock is dirt cheap. I mean, it's trading as if its profits will permanently decline by 30%. We don't think that's the case. Obviously, Amazon trying to build Walmart-like stores is validation that the omni-channel strategy is the way to go. Walmart's dominant in the brick and mortar space, and they're catching up in the online space. And I would submit to you, it's a whole lot cheaper to catch up in online than it is to catch up on brick and mortar. It's a lot more capital. And look, so much of the theme around Amazon was, oh, it's a capital efficient business. It doesn't take a lot of capital to do online. It's so much faster and quicker and more adaptive. Not in the brick and mortar world where Walmart already dominates. And so, look, you see Walmart moving into a higher margin, higher return on capital type of business, and Amazon moving into a lower return on capital type of business. One of them is priced really expensively. Walmart's priced extremely cheaply. It's kind of a no-brainer in our opinion.
Curious, David, if you'd make a similar analogy in picking Disney. I would imagine contrary to, say, a Netflix. I mean, Netflix shares haven't gone anywhere really over the past year.
No, Netflix is still really expensive, and look, I think this is a mismatch, right? Netflix is a featherweight, and Disney is the heavyweight champion of the world in original content creation and monetizing that content. And Netflix doesn't stand a chance, not in the long term. Disney's got a lot of upside. It's the heavyweight champion of the world and successful original content creation and monetization of that content. Netflix is a one-trick pony. It's a small boxer with one punch. All they can do is make money over streaming. And whereas Disney's got theme parks, merchandising, et cetera. It's apples and oranges. And I think the Netflix narrative is beginning to unwind. They're stretching away from their core, trying to get into video games. And it's a matter of time, I think, before that house of cards implodes.
Fair enough. Although, do you have a comment about Disney's flat performance year to date and the fact I think its PE is still around 50?
Yeah, well, I mean, look, earnings are depressed with the acquisition. There's been a lot going on. COVID knocked them back a little bit, right? But that's temporary. When you look at Disney over the long term and the long-term cash flows implied by the current stock price, it's very low. I think the stock could be close to $300 when you take into account the growth and profit potential available to, again, the heavyweight champion of the world in content creation.